On Friday, August 22nd, Jerome Powell delivered his annual speech at the Jackson Hole Symposium, where he hinted that rate cuts could soon be on the horizon. Now, the prospect of easier policy immediately weighed on the dollar, driving it down roughly 1% against the euro, the pound, and the Australian dollar. Interestingly, though, while the euro and the pound gave back most of the gains the following session, the Australian dollar held firm. That resilience may stem from its role as a commodity currency, backed by Australia's heavy dependence on metal exports to fuel growth. The broader takeaway is this: if the U.S. drifts toward a weak dollar stance while inflation stays above target, commodities, led by gold, could outperform other assets in the years ahead. That thesis appeared to gain traction on Monday, August 25th, when the president announced controversial plans to remove Fed Governor Lisa Cook. Now, many analysts see the move as a push to reshape the Fed in line with the administration's preference for persistently lower interest rates. Now, looking forward, the next pivotal data point comes Friday, August 29th, with the release of PCE, the Fed's preferred inflation gauge. The question is whether the number delivers a Goldilocks outcome, inflation high enough to keep commodities attractive, but not so high that it forces another Fed pivot. Expectations call for a 2.6% year-over-year increase in the headline figure. A sharp downside miss could undermine the commodity trade, while an upside surprise could delay the rate cut that had been fueling it. The CME offers three different sized currency contracts: the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. We're going to be using the micro in these examples. If a trader believes the Australian dollar will continue higher from here, they could express that by buying the September micro Australian dollar futures contract at 0.6498 and target a move to the July highs of 0.6625. A stop for this trade could be placed below at 0.6400. This trade can make $127 if the target is reached and risks $98 if you stopped at your level. Now, if a trader believes that the Aussie dollar could fall from here, they could sell the September micro Australian dollar contract at 0.6498 and target a move to 0.6200. Now, a stop for this trade could be placed above at 0.6700. This trade can make $298 if the target is reached and risks $202 if you're stopped out of your level.